Hi, welcome to today's video and thanks for joining me. Today we're going to be answering this question: how did we save $400,000 for this client on their estate taxes? Well, that's a large amount of money. Some might save more, some might save less. But today I'm going to be sharing with you how we went about saving this amount of money. It's a lot of money. And I'm going to share with you sort of not what to do and how you lead up to that. So this example really is sharing with you how you shouldn't really save your money in this fashion, because it leads to this problem. But it does show a solution of how to get out of this problem. So it'd be interesting for you to watch this video today. I hope you see yourself in this video in the sense of how to do a withdrawal strategy and how to pay less taxes. I hope you enjoy it. If you're new to this channel, thanks for tuning in. My name is David. I'm an active advisor working with individuals, families, and business owners right across Canada. I've been doing it for about 22 years now. I love what I do. I start off by creating financial plans for all my clients. Whether it's just an individual who wants a financial plan, if you're an investment client of mine, you absolutely get a financial plan. So I do that with all my clients, because I really believe that when you have more information, it leads to better questions, and better questions lead to better outcomes. It's why I create this channel and did the videos that you're watching today, so that you can have your questions answered and get more information. So I hope you enjoy today's topic. Let's get into why you're here today. Now, most people have a contribution strategy and they don't have a withdrawal strategy. So let me ask you a question. When you go to use RRSPs, if you're using RRSPs, do you tend to follow the same pattern? That is, what's your income, what's your budget, and how much money you're going to get back from after filing your income tax as a result of making an RRSP contribution? Is that sort of the box that you follow? Well, the real way that you ought to be using your RRSP is thinking about the end in mind. How much money you're going to need to live on every year, where that income stream is going to come from. So how much money will you need at your retirement date that's going to provide the income stream, and out of which accounts is that money going to flow to? So that withdrawal strategy, that tax efficient withdrawal strategy, that leads you to your deposit. So it's working backwards as opposed to the other direction. Try that going forward. Now, if you're watching this and you're young, think about the end in mind. Talk to other people. If it's not a financial advisor, talk to other older people. How do you receive your income? Learn about that, or just watch some of my videos. Now, I'm going to dig into the software now. I'm going to show you some really interesting things. It's going to look kind of confusing, but don't worry. I'm going to lead you all the way through every step of the way. But before I do that, let's just introduce William and Elizabeth. Now, William and Elizabeth want to retire early. They want to retire at age 58. So they have 4 retirement goals. Retire at 58. They want $10,000 per month of after-tax income. That's a lot of money, $120,000 to spend on anything you like. They want to lower their income taxes, and they also want to leave behind at least $1 million. That's 4 huge retirement goals. You might see yourself in that because they're fairly common goals. The only difference is what do you have available to actually make that happen? So that's what we're going to dig into right now. And it all begins with a financial plan. It's seeing the outcome of your planning decisions before you commit to them. And you're going to really see how that works when you dig into the software. So let's get in there right now. Okay, so what we're looking at right now is our financial planning software. And it looks like a lot, but when I break it up, it'll make it very easy to understand. Along the left-hand side, you see their age and the years. And so obviously they're 55 now, but they want to retire when they're 58. So that's why this is black here. And we're starting their income stream exactly in the year that they retire. They want to have, there's that $120,000 of after-tax spending, and we're going to have that where they want to have as a goal $120,000 from age 58 all the way out to age 70, and then we're going to phase that down as they get older and less mobile. Kind of a normal thing to do. Now, what do they have? I just mentioned you got to have the assets. So they've got about $1 million of assets. About 1 million is in RSPs, and they've got a little bit in a tax-free savings account. And they also have a house, about 1.8 million with no debts. You can see 0 debts against it. So they've got some assets, but what do we see here? We see this pink shaded area means they've run out of money. At what age? Look at this, at age 65. They've in order to produce $120,000 of after-tax income, the withdrawals necessary they're actually going to run out of money. So if we just simply said to them, no, you can't retire with $120,000, that wouldn't be accurate. There are ways to help them retire, and we just have to consider whether or not that's something that William and Elizabeth would want to do, right? There's a couple of different ways we can help them. I'm going to share just one of the ways right now. So let's look at William. Right now, in this scenario of William, I mentioned that high tax rate. In order to withdraw from his RSP to supply that $120,000, look at this, $183,000 redemption, keeps going. And you can see what happens. There's a marginal tax rate, that 47, almost 48%. Well, let's call it close to 50%. All the way through here, that's not ideal. They're giving up over $50,000 a year to Revenue Canada to be able to support that. And when they do that, they run out of money. So that's not a solution, right? Obviously, it's not a solution. And by the way, Elizabeth, she only had about $83,000 in the tax-free savings account, so the money's running out pretty quickly. So when you look at this scenario, that's not ideal, but they're committed to retiring at age 58, and they're committed to having $120,000. They want $10,000 of after-tax income. So can we still do this? Let's look at it. So switching to this scenario now, you see age 58, that's not changed. Still $120,000, but what do you notice here is that all that pink shaded area is gone. That means they have enough money. And you say, how is it possible they have enough money? I just showed you that they ran out of money. Well, we got to look at their assets. Their assets are, they have cash, a lot of cash, but that's got to last all the way to age 85. But they also had a house that was worth $1.8 million. They're sitting on $1.8 million of cash, basically. That's sofas and windows and furniture and everything else. So you got to think about, maybe that has to be part of the retirement strategy. So let's look at how that works. So if I just slide this over to William, you'll see that we're doing early withdrawals on his RSPs, $50,000 per year, from age 58 all the way through to age 70. And that $50,000 allows him to still be under the lowest tax bracket. You see here 20.05%. And look at the tax, very little tax, $4,000, $4,000, $4,000, $3,600, very little tax. That's what we're aiming for here. We want to lower that tax bill, but we still need $120,000. We're only getting 50 here, and we haven't started CPP yet, right? So we have a dilemma. We need more money. Where are we going to get it? We're going to get it from the house. So we can take a line of credit. Now, there are two ways to do this. We could do a chip reverse mortgage, but they're very young still. And with a chip reverse mortgage, when you're younger, you don't get as much equity. And so it might very well be that they can't do or shouldn't do a chip reverse mortgage. They'll just simply do a lifestyle line of credit for their house. Maybe later on, if they wanted to do this in their late 70s, a chip reverse mortgage would be ideal. But in this case, just going to do a line of credit. Going to borrow $75,000 against the house each year all the way out to age 70. You say that's a lot of money. I know it's a lot of money, but something remarkable is also happening. The house is going up in value. At the time of when they start to do the withdrawal, their house is worth $2 million. This joint, so $1,994,000 times 2, so it's $2 million house. And by the time we're done borrowing against the house is worth $3 million. So even though they've got interest on the house, their house is also appreciating. So it's sort of like canceling each other out. So we're really just taking the future value of the house as we go along here. In any case, you get the 75 plus the 50. That is where you're going to get the 75,000 loan is non-taxable. So that keeps the tax rate low. So you can get this $120,000 all the way through. And what happens when they're older and they don't need the house and they downsize? Well, let's look at that event. You see here's the house, and we'll go all the way down. We're going to sell the house at age 77. They're going to sell the house for $4 million, and then they're going to buy an $800,000 condo and live in a condo and just live very easily. And they're going to put the rest of that money into their investment account. So you see the deposits going in here. So now they have even more money to use throughout their retirement because now they're older and they got all this equity still, and even after borrowing against their house. So you can see here that their assets are declining and they get down to RSP value of $271,000, and they got a tax-free savings account and a non-registered account, and they're only paying $100,000, $105,000 of their estate, and they're leaving about $2,656,000 to their beneficiaries, so more than that million. So by tapping into the equity in the house, they're able to say, we want to live large, we want to live a really awesome lifestyle and use the equity that we've built up in the house and the advantage that the house is appreciating every year. We're just going to tap into that equity, keep our income high, low tax rate, and still retire with plenty of money and leaving plenty of money behind. It's an excellent solution to their problem. Otherwise, they would have had to lower their income in order to not run out of money. And they would be sitting in all this equity in their home, but they would have to lower their income. Doesn't seem right. So that is, I think, an eloquent solution to their problem. We're able to solve all 4 goals for them and have a wonderful retirement and leave behind the money they wanted to. Well, I hope you enjoyed this video. If you have any questions, please put your comments below. I want to hear what you think about using equity in your home, if you think this is an interesting solution. As always, if you find this information useful to you or to anyone else, share it with anyone that needs to know this. I look forward to seeing you in the next videos, and thanks again for tuning in. It was good to see you again. Take care.